Whenever a major conflict breaks out in the Middle East, one thing almost always happens: oil prices begin to rise. But why does war thousands of miles away suddenly make petrol, transportation, and even food more expensive around the world? In this video, we'll break down exactly why oil prices rise during conflict and why it matters for investors and everyday consumers. Oil is one of the most important commodities in the global economy. It powers cars, ships, airplanes, factories, and even electricity production in many countries. Because so many industries depend on oil, any disruption in supply can quickly affect prices worldwide, and this is where war becomes a major factor. When conflict breaks out in regions that produce or transport oil, global markets immediately begin to react. The first reason oil prices rise during war is fear of supply disruption. Major conflicts create uncertainty about whether oil production will continue normally. Oil wells could be damaged, pipelines could be shut down, and exporting countries may reduce shipments. Even if oil production hasn't actually stopped yet, the fear that it might is enough to push prices higher. Energy traders and investors begin buying oil early, expecting that supply could become tighter. This increased buying pressure pushes oil prices upward in global markets. Another major reason oil prices rise during conflict is the risk to global shipping routes. One of the most important oil transit points in the world is the Strait of Hormuz. Roughly 20% of the world's oil supply passes through this narrow waterway between the Persian Gulf and the open ocean. If conflict threatens this route, millions of barrels of oil could suddenly be delayed or blocked from reaching global markets. And when markets believe supply could shrink overnight, prices tend to move quickly upward. At the heart of rising oil prices during war is a simple economic principle: supply and demand. If supply is threatened or reduced, but global demand for oil remains the same, prices must adjust upward. Think of it like this: if fewer barrels of oil are available, but the world still needs energy, buyers are willing to pay more to secure supply. This is why geopolitical tensions can cause oil prices to move rapidly even before actual shortages occur. When oil prices rise, the impact spreads throughout the entire economy. Transportation becomes more expensive, which increases the cost of moving goods. This can lead to higher prices for food, consumer products, and services. In countries where fuel costs directly affect daily life, rising oil prices can quickly increase the overall cost of living. This is why global conflicts often lead to inflation pressures around the world. So when you hear about rising oil prices during global conflicts, remember that markets are reacting to three key factors: supply risk, shipping disruptions, and basic supply and demand. Understanding these forces helps explain why geopolitical events can have such a powerful effect on global energy prices. And it reminds us that in today's interconnected world, events happening far away can still affect our everyday finances. Please like this video, subscribe to Finance with Successful Success, and share it with someone who needs to see it.